Good morning, Governor Indrajit Coomaraswamy, Your Excellencies, members of the Monetary Board, secretaries to the ministries, deputy governors, colleagues of the central bank, members of our consultative committees, and distinguished invitees, ladies and gentlemen. It gives me a great pleasure to welcome all of you to this important event, which is one of the most important events in our central bank calendar. Every year we announce our policies and measures in relation to all central bank activities that we are going to take during the year, next year mainly, and also 3-year period. Why this is most important event, especially for all our stakeholders, because by announcing our policies in a much more transparent manner, that would help a lot of other stakeholders to make their investment business decisions and policy decisions that would help them to make those decisions with much more clarity of all central bank policy. This is the reason why we are doing this for now, since 2007. This is the 11th year that we are doing this. So because of that, we have invited especially the excellencies, members of the diplomatic community, secretaries and additional secretaries to the ministries. Those are relevant to our activities, and also our all staff, senior staff, and also our members of the all consultative committees. Especially there are 3 consultative committees I would like to recognize here: Monetary Policy Consultative Committee, Financial System Stability Consultative Committee, and Monetary Board Advisory Committee. And also officials from ministries that we are directly working, especially the Ministry of Finance and Ministry of National Policy and Economic Affairs. We would welcome them as well. And also, in addition, there are several heads of government institutions, departments, corporations, statutory bodies, and representatives from international agencies like IMF, World Bank, ADB, all these institutions. And obviously, more importantly, the senior management chairpersons of and CEOs of institutions that come under our regulations, like the commercial banks, licensed specialized banks, finance companies, and specialized leasing companies, and private dealers. So for all of you, again, on behalf of the central bank, I would like to welcome you for this important event. And without further ado, let me invite Governor to deliver this year's roadmap. Thank you.
Your Excellencies, Dr. Gokan, our Executive Director at the IMF, members of the Monetary Board, secretaries to ministries, Senior Deputy Governor, Deputy Governors, officials of the Central Bank, my colleagues, distinguished invitees, ladies and gentlemen. Happy New Year, and firstly, let me warmly welcome you to the presentation of this year's roadmap. Now, my colleagues have put together a wealth of very insightful information. In the interest of time, I'm not going to be able to read the whole document. So I would encourage all of you to look at particularly the sections that are of relevance to you on our website. The document will be on the website today. And I'm not leaving things out because they're not important. It's just in terms of managing time. Now, continuing our tradition that was initiated in 2007, today, we are pleased to present the 11th roadmap of the Central Bank of Sri Lanka. It is our belief that sharing our future policy directions and actions would help you to plan your business trajectory with greater certainty. I hope this roadmap will enhance the transparency and clarity of our policies, as the Senior Deputy Governor said, and this would help you to achieve your targets more effectively. The successful outcomes in your businesses would in turn ultimately help us to implement our policies more effectively for the benefit of both the economy and the people of this country. The year 2017 was challenging. We have seen economy-wide effects due to inclement weather conditions. The drought and flood disturbed agricultural activities and agro-based industrial activities, as well as services related to the movement of agricultural goods. The spillover effects of these weather conditions as I said, impacted other sectors of the economy as well. As a result, economic growth is expected to be subdued and lower than we projected at the beginning of the year. The tight monetary policy stance of the central bank, as well as the relatively tight fiscal policy stance of the government, which were adopted with the aim of regaining macroeconomic stability, partly affected public and private investment spending that also contributed to low economic growth. Consumer price inflation increased, mainly due to high food prices associated with weather-related domestic supply disruptions, revisions to indirect taxes, and increased prices of import commodities. This made our efforts to anchor inflation expectations challenging. Despite the tight monetary policy stance maintained by the central bank, growth of monetary aggregates was high during most of 2017, before decelerating to envisaged levels towards the end of the year. The transmission took longer than we expected. Although we have seen signs of a firm recovery in exports with better prospects in key export markets and the flexible exchange rate policy of the central bank, the trade account continued to be affected by a largely weather-induced increase in import expenditure. Imports of rice and fuel in particular led to pressure on our import bill. The decline in workers' remittances resulted in a reduction in the cushion against the widening of the trade deficit in the external current account. As you know, for many years, about 80% of the trade account deficit was financed by remittances. There has been a slight reduction in remittances, which has meant that the percentage of the trade deficit covered by remittances has come down, but it is still a very substantial proportion that is covered. The substantial proportion of the trade deficit is still covered by remittances. Although the fiscal sector has recorded notable improvements in terms of revenue collection, some slippage in the budget deficit is likely in 2017, mainly as a result of weather-related fiscal costs and higher interest payments. This could have an adverse impact on achieving the envisaged fiscal consolidation path while complicating the conduct of monetary and exchange rate policies. As things stand, however, we are still broadly on track in terms of the fiscal consolidation program in the medium term. It's important that electoral pressures and other considerations don't throw us off track, but for the moment we are broadly on track. Despite these challenges, 2017 was a year when we made significant progress on many fronts through several policy measures taken by the central bank in coordination with the government. In response to these measures, macroeconomic stability is being restored and our economy is trending in the right direction. The central bank has implemented several proactive policy measures during 2017 in order to achieve the core objectives of maintaining economic and price stability and financial system stability. 3 frameworks have been put in place to improve the country's overall macroeconomic condition. Attention is also being paid to institutionalizing them. This is very important. We've had these frameworks, which we've elaborated on before, and I will continue to do that today as well. So we're having a framework for fiscal consolidation, a framework for monetary policy formulation, and for exchange rate management. But what we're now trying to do is to institutionalize them so that there is greater resilience and durability in these frameworks. The central bank is working towards implementing a flexible inflation targeting framework by 2020 to conduct monetary policy in a proactive and forward-looking manner. It has also adopted a more flexible exchange rate policy that promotes export competitiveness. The government is also committed to a revenue-based fiscal consolidation program which intends to bring down budget deficits and debt levels progressively. If we get fiscal policy and monetary policy right, then the pressure on the exchange rate would reduce automatically. Now let me discuss these frameworks in a somewhat more detailed manner. On the monetary policy framework, the central banks move towards introducing a flexible inflation targeting regime, or FIT, aims to maintain a low inflation environment on a sustained basis. The FIT framework is a data-driven, forward-looking and proactive monetary policy regime built upon 3 main pillars. That's strong fiscal policy support, effective monetary policy conduct, and strong central bank mandate and credibility. The government has also endorsed this move to adopt a FIT regime as stated in its Vision 2025 document. In order to successfully implement the FIT framework, we have formulated a roadmap outlining several milestones to be completed by the government and the central bank, including the necessary legislative, institutional, and operational changes. The IMF has also recognized our move towards FIT by giving us the necessary technical assistance on capacity building. The central bank has also accommodated greater flexibility in the exchange rate in 2017 by allowing market forces to determine the rate. The market reacted positively to this policy initiative by reviving the spot market, which was inactive for a relatively long period of time. The central bank continued to absorb foreign exchange from the domestic interbank foreign exchange market in order to build up the quantum of non-borrowed foreign exchange reserves. Now, we ended the year with gross official reserves of $7.95 billion US dollars. We started with $6 billion, so the reserves rose up to $7.95 billion. We have a payment of about $500 million on the Asian Clearing Union, so in a couple of days, so it'll come down to about $7.5 billion. And not only has the volume of reserves increased, but the quality has improved as well. We've been able to reduce short-term liabilities. Short-term swaps have been reduced from $2.5 billion US dollars to 2.4 billion US dollars to 1.5 billion US dollars, almost $1 billion reduction of short-term liabilities. At the same time, reserves went up by almost $2 billion. So improvement in quality as well as volume. And the fact that the central bank was able to purchase in net terms about 1.7 billion US dollars during the course of the year meant that there were significant non-debt creating flows that have gone into our reserves as well. So all this has meant that not only has our volume of reserves gone up, but the quality has increased as well. So broadly, these developments help to smoothen the exchange rate's behavior as well. There were even some instances of appreciation of the rupee in 2017, indicating significant inflows to the foreign exchange market. Sri Lanka also received the fourth tranche of the extended fund facility of the IMF in December 2017. A total of US dollars 759.9 million has been received so far from the IMF as part of the EFF. Now, if you take the executive board's approval of the last review of the EFF facility, the fact that money is continuing to come into the government securities market, as well as the stock exchange, as well as the fact that both Fitch and Standard & Poor have taken away the negative outlook on our rating, though Moody's have retained it. But on the whole, these are external endorsements of the fact that the economy is steadily stabilizing. We certainly haven't won the war, but we are winning a few battles along the way. The fact that the IMF board approved the last review confirmed Sri Lanka's satisfactory performance in achieving the IMF EFF targets during 2017 in terms of specified performance criteria and certain structural benchmarks. Earnings from exports increased owing to the recovery in key export markets, as well as the central bank's policy of maintaining exchange rate flexibility. This was supported by conducive external trade policies and improved macroeconomic conditions in the country. Further, the reinstatement of the EU GSP facility, the expected conclusion of free trade agreements with Singapore, China, and India, and strong institutional and policy support are also expected to drive the momentum in exports. We've seen exports going up since March, and I think in the last 3 or 4 months, we've had exports amounting to over $1 billion a month. We've also seen an increased inflow of FDI in 2017, and we expect FDI to gain momentum through the commencement of the Hambantota Industrial Zone and the continuation of the Port City project. Higher inflows to the government securities market and the Colombo Stock Exchange, as I said, as well as long-term financial flows to the government, were also witnessed during the year. With these developments on the external front, the central bank was able to build official reserves, as I said, up to $7.95 billion at the end of the year. On the fiscal front, the government has embarked on a revenue-based fiscal consolidation path to strengthen the country's public finances. The government expects to reduce the budget deficit to 3.5% of GDP by 2020 and thereby reduce government debt to a sustainable level in the medium term. It is in the process of implementing several reforms aimed at improving government revenue collection while rationalizing government expenditures to adhere to the envisaged fiscal consolidation path over the medium term. A positive primary balance is expected in 2017 for the first time since the early 1950s, and a surplus in the current account is also expected in 2018 for the first time since 1984. These are clearly major improvements. The fiscal performance of the government has been the main source of instability in the system ever since the economy was liberalized in 1977. This has been a major problem, and it's encouraging that these structural deficits, both in the primary account as well as in the current account, are now being turned around, and for the first time in decades, really, we are beginning to see a surplus. This is a major advance. Again, though, winning battles, but not quite the war yet. The reform agenda of the government includes improving financial viability of state-owned enterprises to mitigate the budgetary implications for the government. While introducing clear frameworks and reforms in relation to monetary and exchange rate policies in 2017, we have implemented several policy measures during 2017 to address the challenges in the financial sector and maintain a stable financial system for effective monetary policy transmission and to support sustainable growth. With a view to promote a dynamic and resilient financial sector, the regulatory and supervisory framework of the central bank was strengthened in line with international standards and best practices. At present, our banking sector accounts for over rupees 10 trillion in assets. So this was a landmark that was crossed this year. The assets of the banking sector passed the rupees 10 trillion mark, while the non-bank financial institution sector accounts for over rupees 1 trillion in assets. The implementation of Basel III capital standards was commenced in 2017 in order to develop a more robust banking sector. The framework to regulate the non-bank financial institutions was strengthened under challenging conditions, and resolution of distressed finance companies has commenced. During 2017, the central bank continued to strengthen the regulatory framework of the microfinance sector as well, and continued to combat the menace of illegal pyramid schemes with the assistance of other government agencies. Several measures were adopted to strengthen and modernize the payment and settlements infrastructure in order to develop an efficient and stable payment and settlement system in the country, as well as to pave the way towards a digital economy. Being a trusted and professionally competent and strong institution, the central bank is entrusted with vital agency functions. Accordingly, as per our mandate, we carried out public debt management with the objective of mobilizing the government's financing requirements at the lowest possible cost and with a prudent degree of risk. The framework for public debt management was reinforced by introducing a transparent market-based auction mechanism for the issuance of government securities. This has already resulted in desirable outcomes of lowering interest costs to the government, efficient price discovery, and improved transmission of monetary policy signals across the benchmark yield curve. The Employees' Provident Fund, which is the largest superannuation fund in the country, is managed by the central bank. It passed a significant milestone during 2017, with total assets of the fund surpassing rupees 2 trillion. The central bank also continued to promote financial literacy and inclusiveness and helped entrepreneurship development through our credit schemes for agriculture and livestock, as well as the MSME sector. In addition, we also adopted measures to promote a clean note policy in the country, and improvements were also made in currency operations and processing. In 2017, the central bank implemented a new legislative and policy framework for foreign exchange operations based on the new Foreign Exchange Act number 12 of 2017. Provisions of the new act are being implemented through the newly established Department of Foreign Exchange in the central bank, focusing on reducing restrictions, excluding ambiguities, simplifying processes, and enhancing efficiency associated with foreign exchange transactions while striving for clarity and convenience. A significant amount of work needs to be done to improve Sri Lanka's global ranking in the implementation of anti-money laundering and countering of financing of terrorism regulations. The Financial Intelligence Units of the Central Bank is taking several measures to address this with the assistance of key government ministries and departments, as well as stakeholders such as licensed banks, licensed finance companies, regulators, stockbrokers, and insurance companies, and we continue to enter into new MOUs with other country FIUs. This is an area we are very keen to up our game. We are a little concerned about our overall performance in terms of global standards, and high priority will be given to raise our performance in this area. The central bank has already initiated several measures to enhance the economic stability of the country, and it will continue with this endeavor in the future as well. Given improved economic fundamentals and stability, it is expected that the government will implement the necessary policy reforms to uplift the economy from the prevailing low growth trajectory to reach its potential level. The government's Vision 2025 document unveils the future policy direction of the country. The vision envisages transforming Sri Lanka into a hub of the Indian Ocean with a knowledge-based, highly competitive social market economy. Accordingly, considering the limited scope of the domestic market, sustained future economic growth would have to be generated from external demand. Hence, effective and sustainable long-term policy measures have to be implemented for accessing foreign markets through exploiting trade and investment opportunities. Now, if I may talk a little bit about growth, because I think you would have seen implicit in my remarks so far that we are making steady progress in terms of stabilizing the economy. However, on the growth side, we are likely to end up with an annual growth figure of a shade under 4%, which is disappointing. But we expect growth to pick up to somewhere between 5 to 5.5% next year. And the reasons for that is the tailwind from the global economy. Our major markets in the US and Europe are doing well, and we've got the restoration of GSP Plus should really kick in even more next year. And of course, we're coming off a very low base as far as the agricultural sector is concerned, which has experienced negative growth during the course of 2017. So all this, I think, will give upward pressure. But I should say something about growth and how one gets growth going. There's a temptation when growth is below potential to loosen macroeconomic policies inappropriately. There's sometimes even pressure that comes for you to do this. That is wholly inappropriate because you end up just getting into a stop-go cycle. And this is what we've done in the past. We have to drive growth through economic reforms. And that, there is no easy way. And in a way, the country had to go through a phase of low growth. I think it's a good analogy is an alcoholic. For an alcoholic to get out, he has to go through a period of I've forgotten the term now, where you have to, to get the whole thing out of your system. Now, we have had a situation recently where we have to do fiscal consolidation because of the debt dynamics. We had to have a tight monetary policy stance because credit growth was too high, the monetary aggregates were too high. And of course, when one does both these things, growth will automatically be more muted. But these things had to be done. Now I've got the word, cold turkey. In the same way, alcoholics have to go through cold turkey to get on the right path. This economy, which had over-binged with inappropriate macroeconomic policies, had to go through cold turkey to get on a growth path which can be sustained. And that's what has happened. That's why we're having this low growth. And the way to get out of it is to do the economic reforms, which will strengthen the growth framework in the economy. And that's all there in the Vision 2025 document, which you can refer to. We also observe that frequent natural calamities hamper economic activity, resulting in a moderation of economic expansion. This highlights the need for diversification of growth drivers in the economy, as well as putting the necessary measures in place to strengthen the economy's resilience through mainstreaming sustainability into the planning and budgeting processes and improving disaster preparedness. In the global context, after having a series of economic distortions and negative shocks after the global financial crisis, now the global economy is gradually recovering. Investment conditions have improved, and global trade also rebounded in 2017. So we need to exploit opportunities created by the revival of global growth, supported by synchronized economic expansion in Europe, Japan, and the US for the first time since the global financial crisis. Better prospects in Europe and the US, which are our two largest markets, are clearly tailwinds. This is growth positive for Sri Lanka. However, we should also be mindful that gradual normalization of monetary policies in the advanced countries could pose some challenges to the economy on both external and fiscal fronts. On this, in terms of the external dimension, of course, the key advantage for the country is our location, as we all know. And the fact that we're in Asia, and 20 miles from what is, I think, again, will be the fastest growing large economy in India, and we are right in the middle of the China's maritime Silk Route. So this location is what we have to leverage. And in terms of growth potential, leveraging our location as a hub in the middle of the Indian Ocean, which is actually what our roots are. If you think back of Sri Lanka over the millennia, it has really been a trading post in the middle of the Indian Ocean. And we need to rediscover our roots. And that, again, will be a key driver of the growth process. It can help to strengthen the growth framework and to increase the growth potential of the economy. Sri Lanka is gradually transforming to upper middle income country status. Sustained progress will inevitably involve greater integration with the world economy. While creating opportunities, this will also expose the economy to greater uncertainties and risks. In order to face the current and future challenges proactively and to address the already identified deficiencies in the existing processes, the central bank, as outlined in the strategic plan for the medium term, expects to robustly strengthen its institutional frameworks by A, enhancing the monetary policy framework, B, strengthening the financial sector oversight, C, modernizing payments and settlements, and D, upgrading public debt management. In fact, we've also taken a new approach to our strategic planning after experience of 10 years. We're having a much greater focus on impact and outcomes. In the past, we've tended to focus on inputs and outputs. This time, we want to see what the impact of our policies are. And so we've gone through a process with some assistance from the Bank of England as well to have an approach which is far more focused on impact and outcomes. And in the process, we've identified 6 bank-wide priorities, which will now enable us to kind of address some of the silos that may exist in the system and to have a bank-wide approach to some of the key challenges confronting the institution. The improved policy frameworks will enable the country to take advantage of greater integration while mitigating the risks involved and increasing the resilience of the economy. In this respect, as already mentioned, we are steadily progressing towards an effective FIT framework to ensure price stability. At the same time, we are striving to promote a dynamic and resilient financial sector in order to lower vulnerabilities in the financial system. This is a priority for achieving objectives in relation to growth, employment, and incomes. Modernizing the infrastructure of the payments and settlement system to pave the path towards a less cash society and facilitating a digital economy are also important policy priorities in the medium term. We are also determined for prudent debt management with a view to ensure debt sustainability, enhance effectively and transparency of the primary auction system, promote market development, and minimize risks. Our policies are aligned to achieve these strategic priorities, which will be instrumental in supporting the country's economic and price stability and financial system stability. In this context, the roadmap for 2018 reviews the policy actions that have been pursued during 2017 and, more importantly, proposes policies and actions for the forthcoming period. Now, the outline of the roadmap, I've given you the introductory part, which is basically a summary of what has happened in 2017, and also giving you some pointers as to what to expect this year. The next section focuses on central bank's monetary policy strategy and policies for 2018 and beyond. Then the subsequent section on the central bank's policies related to the financial sector performance and stability. And the final section is related to strengthening the broader economy through the central bank's agency and ancillary functions. So what I will be doing is to expand a little bit on what I have given you by way of a summary in the introduction. And if I can just kind of try to pull out some key points, some takeaways from that summary, I think the big headline message is the economy is stabilizing steadily. We're going in the right direction. Growth is still a challenge. It has to be driven through reforms. The two key problems historically have been, one, the budget deficit, and there is significant progress being made there. We need to persist. And the related problem, because the excess demand created by the budget deficit tends to flow into the balance of payments and creates pressure there. And we are beginning to see some improvement in terms of export performance. And of course, we need to improve in terms of FDI, and there has been an upward trend which needs to be maintained, and the momentum has to be increased. So that's basically the summary of where we are at the moment. But let me now give you a little bit more detail in terms of the monetary policy strategy and policies for this year and beyond. The central bank seeks to achieve its price stability objective through the conduct of monetary policy. Based on the current monetary policy framework, we have been able to maintain inflation in single digits for close to a decade. Going forward, the introduction of an effective FIT framework will improve our capacity to deliver price stability. Our motivation towards adopting inflation targeting as the monetary policy framework was signaled a number of years ago. The weakened relationship between money and inflation and deepening financial markets were among the major factors that encouraged this move. Under the proposed FIT framework, the central bank will aim to preserve price stability of the economy by targeting an inflation range of 4 to 6%. We believe that this target range is desirable for a country like ours in view of the vulnerability of the economy to supply or external shocks. We will employ market-based instruments, particularly the policy interest rates and open market operations, OMO that is, of the central bank to influence market conditions and to navigate inflation in the targeted middle single-digit range. Variables such as overall monetary expansion and credit to the private sector will remain key indicative variables to guide monetary policy conduct. We have now progressed into a time-bound plan to make this leap towards FIT a reality. The period starting from 2018 will be vital in laying out the required reforms to facilitate a smooth transition to a complete FIT framework. In this context, we have identified 3 important pillars as the building blocks for adopting of FIT framework. 1, the central bank to have a strong mandate and credibility. 2, effective monetary policy conduct. And 3, strong fiscal policy support and commitment. Let me take each of those in turn, if I may. Strong central bank mandate and credibility is essential for successful adoption of FIT. There is considerable evidence from around the world that weak legal mandates, together with inadequate autonomy of central banks, hinder the success of FIT. In this context, Sri Lanka will also have to introduce considerable changes to the existing mandate of the central bank through necessary legal reforms. The current framework is hampered by the focus on non-core activities, monetary financing, that is accommodating the government deficit or fiscal forbearance, and inadequate autonomy. Amending the Monetary Law Act is therefore imperative to enhance the focus of the mandate as well as the central bank's autonomy, governance, transparency, and accountability. These amendments would broadly include strengthening the mandate for price stability, separating monetary and fiscal functions, strengthening the central bank's autonomy, and introducing institutional arrangements for setting inflation targets and maintaining accountability. Second, the second pillar, that is effective monetary policy conduct. This is clearly a vital building block for maintaining low inflation under the FIT. We need to establish a sound, forward-looking decision-making process based on reliable macroeconomic forecasts and projections. In this connection, the central bank has already improved technical capacity in modeling and forecasting of key macroeconomic variables. The central bank and IMF have jointly developed a structural model-based forecasting and policy analysis system, that's FPAS, which encompasses near-term and medium-term model-based projections. Analysis based on FPAS is already supporting the monetary policy formulation process in a more proactive and forward-looking manner. The central bank will continue to improve model-based projections through building sound technical infrastructure for inflation forecasting and macroeconomic analysis. Moreover, the monetary policy formulation process is also being upgraded by introducing a forecast calendar which outlines the schedules for projections and revisions of forecasts linked to the availability of important economic data and events. The number of MPC meetings during a year have been reduced to 8, allowing for sufficient time for technical staff to undertake more sophisticated macroeconomic analysis. In the new forward-looking framework, it is of utmost importance to monitor developments in both current and future economic conditions. In this regard, we will strengthen the existing surveys of expectations and economic conditions to gain forward-looking insights to improve accuracy of forecasts. With regard to monetary operations, the domestic money market is being actively managed through open market operations to steer the average weighted call money rate in line with the monetary policy stance of the central bank. We have taken several progressive measures to communicate more information, including cut-off yield rates of the OMO auctions and overnight liquidity estimates with a view to encouraging more efficient price discovery in the money market and promoting informed decision-making by market participants, as well as to improve market signaling of the OMO operation. The central bank will continue to actively engage in liquidity management while guiding the short-term interest rate along a desired path. Several measures, such as reviewing the compilation methodology of benchmark interest rates, strengthening the operational framework pertaining to intraday liquidity facility, introducing role-based code of conduct for authorized money brokers, and promoting market development, will be taken to improve the efficiency and compliance in respect of monetary market operations. Thank you very much. There's no flat seconds. Thank you. As announced last year, the Monetary Policy Consultative Committee was re-established in mid-2017 to draw on external expertise to support the conduct of monetary policy. We will continue to take on board stakeholders' views in formulating monetary policy. As the conduct of monetary policy is dependent on an effective and prudent exchange rate policy, the central bank has introduced a more market-based exchange rate system. It has allowed more flexibility in determining the exchange rate based on market condition and has intervened only to smoothen volatility and to build up reserves. It is noteworthy that there has been a build-up of non-debt creating international reserves during 2017 with minimal impact on the exchange rate. Going forward, foreign exchange intervention policies will be adopted which are consistent with a flexible exchange rate regime and supportive of improving foreign exchange market functionality. On the exchange rate, again, in the same way as the FIT framework has clear rules which support it. Again, in the case of the exchange rate, the central bank is working to adopt parameters for guiding the management of the exchange rate. We're not reinventing the wheel here, as many other countries have adopted such parameters. We need to customize those parameters for our local market conditions, and we'll also be introducing certain rules to improve the functioning of the FX market. Now, in line with this policy, we will continue to focus more on non-debt creating financial flows and building up reserves. Ongoing policy reforms of the government focus on boosting exports as well as attracting FDI. This gives greater salience to our agenda of maintaining flexibility in the exchange rate to boost competitiveness. The Board of Investment has estimated FDI to have reached US dollars 1.5 billion in 2017. That is an important milestone and could possibly be a turning point in FDI inflows. The commencement of the industrial zone in Hambantota and Port City continued to bring significant FDI flows, as I said earlier. And we expect annual FDI flows of US dollars 2 to 3 billion in the coming years, in the medium term. In addition to boosting growth and employment, this will also enhance external sector resilience by generating non-debt creating inflows and boosting exports. The central bank will continue to manage reserves in line with a model-based strategic asset allocation framework to ensure foreign exchange reserves are managed with the objective of ensuring an adequate level of liquidity and a reasonable return in comparison to benchmarks. Now, inflation targeting is all about the management of expectations. And here, we will be placing a very high premium on effective communications and a great deal. We're thinking through this very carefully. We are working with the IMF. They're providing us with some technical assistance as well as to how best to communicate the formulation of monetary policy using the flexible inflation targeting framework. And there is a great deal. Those of you who are interested, I suggest you look at this section of the roadmap whereby we give you a lot of detail as to how we will be improving communications through various publications, reviews, etc. In addition, in accordance with the commitment that we made last year, there is an advanced release calendar for the regular monetary policy announcements. The first such announcement will be on the 16th of February, and then onwards, every 7 weeks or so, we will be having monetary policy announcements. The calendar, again, is in the roadmap, which you can access from the website. Now I've talked about the central bank's mandate and independence, and I've talked about the need for effective monetary policy conduct. And the third pillar is, of course, good fiscal monetary coordination. The central bank cannot implement a successful FIT framework alone. As we have emphasized in the past, the continued and strong commitment of the government will be of paramount importance. It is encouraging that the government has already recognized the central bank's move towards FIT as the future framework for monetary policy. This recognition is reflected in the Vision 2025 document. Continued strong commitment of the government towards greater fiscal discipline remain key to the successful adoption of FIT. In particular, the government is expected to maintain its commitment to medium-term fiscal consolidation. The improved fiscal space will create a better enabling environment for the effective and independent conduct of monetary policy. This whole effort requires the government's commitment to remain on the trajectory of fiscal consolidation it has enunciated in its medium-term budgetary framework. The new Inland Revenue Act, enacted with the aim of simplifying and rationalizing the existing income tax structure, the VAT reforms, and the improvements in tax administration are worthy achievements. Further, the government expects to strengthen fiscal consolidation by revising the Fiscal Management Responsibility Act to include binding fiscal targets. This, I must say, is something I think that's important to everybody in the country, particularly in business, because as I said, the fiscal performance of the government has been the main source of instability in the system. The Fiscal Management Responsibility Act which was introduced, I think, in about 2002, has certain targets, but the targets don't have any teeth. So what the government is trying to do, and it needs to be encouraged to do this, is to have some targets whereby there are specific reasons which are given when you can deviate from the targets. targets for the deficit, targets for public debt as a percentage of GDP. And those targets, could only be breached for things like major exogenous shock, which leads to a depression or natural disaster. So there has to be a specific reason why you can deviate, and when you do, you've got to set out a path for getting back on track. So that's there are a number of countries which have introduced this, where you have binding targets for fiscal policy, and this would institutionalize the government's commitment to fiscal discipline, which is essential given the country's external dynamics and exposure to rating agencies and international capital markets. What I'm saying is, I hope all of you will lobby for this. That's what I'm really trying to say, because it is very crucial. It's crucial for the country. Further, to institutionalize the autonomy of the central bank, it is vital to shield monetary policy from fiscal dominance. In this regard, a strong legal and institutional mandate for the central bank is necessary to ensure a clear separation between monetary and fiscal policy as part of the transition to the FIT. This requires phasing out of monetization of fiscal deficits by the central bank. This will also pave the way to a deeper and liquid financial market, which will be a catalyst for effective transmission of monetary policy. We also see the Liability Management Act proposed by the government as a very prudent strategy. Under this framework, the public debt manager would create a buffer fund to minimize the rollover risk of the debt stock, eliminating the necessity for the central bank to provide financial assistance to the government at the beginning of each year, as per the current provisions of the Monetary Law Act. So that's one advantage. We don't have this rather convoluted process that we go through at the beginning of the year to help the government. Even more importantly, it will create the space to go beyond the government's borrowing requirement in any given year to mobilize financing to address the current bunching of external debt payments from 2019. The government's decision to earmark the proceeds of divestitures for liability management is also a very favorable development in this regard. The $291 million US, which was received as the first tranche as payment for the long lease of the Hambantota port, is now in a DST account in the central bank. And that money is earmarked specifically for liability management. Meanwhile, the government's commitment to reform state-owned enterprises is commendable. In particular, automatic pricing mechanisms for fuel and electricity are expected to be introduced in March and September 2018, respectively. This will go a long way towards reducing the future financial losses of key SOEs and avoid large ad hoc adjustments in retail prices. Now, over 90% of the losses of the CPC and CEB, Mr. Badagodo is here, he will, I hope, endorse what I say, are due to the fact that the government compels these institutions to sell electricity and fuel below cost, to subsidize electricity and fuel. Now, one can argue that that is necessary, but that should be funded from the consolidated fund. If the government wants to subsidize fuel and electricity, it should not be put onto the balance sheets of the CEB and the CPC. And this is what successive governments have done. And they have ruined the balance sheets of the CEB and CPC. I think this should be stopped. Fine, if you want to subsidize, do so, but transfer from the consolidated fund to do that. And ideally, we should move away from subsidies to cash transfers. But that's another story. We need to restructure our social safety net. As we know, the central bank alone cannot manage inflation and inflation expectations in the economy. It cannot influence supply-side factors affecting inflation. Although monetary policy is effective in controlling demand-driven inflation, the support of the government is essential in managing supply-side pressures on inflation. Now, several key milestones need to be reached over the next 3 years through joint efforts of the government and the central bank to fulfill key prerequisites of the FIT framework: legal amendments, continuation of fiscal consolidation, institutionalization of required changes to the monetary and fiscal policy processes, and building awareness and confidence of the general public are priorities in the near future before the official transition to the FIT framework by 2020. The Senior Deputy Governor delivered the Alcott oration at Ananda College 2 months ago, I think, on the FIT regime. And I think we will be doing much more of that. I think he and colleagues working in this area will go out, I hope, and speak on this subject so that we are able to explain what we are doing to gain public support for what is a very important change. You know, now that we are exposed to rating agencies and international capital markets, we need to have a much more structured, disciplined approach. I'll share a little anecdote with you from, you know, I had a misspent youth on the playing fields. And many years ago, when I first had the privilege of getting into the national team, we were about to play a visiting team, a very powerful visiting team called the Bosons, and the union at the time thought it appropriate to get a foreign coach to come and help us to prepare for this. And so they got an Englishman, actually a British Lion, to come and coach us. So for the first coaching session, he had those days blackboards, that's all they had. A blackboard up, which was a bit of a shock to us to start with. And then the first question he asked was, okay, what is your basic game plan? So there was a deathly silence for a while. And then one of my teammates piped up, go Kadagana. That was the game plan. So that's how we've tended to formulate economic policy as well. There has been no plan, no structure. We just kind of make it up as we go along. So I think we need to change. And this flexible inflation targeting and the different frameworks that we've been talking about will help us to effect that change. Okay, as I said, in this regard, as mentioned, the roadmap for adopting FIT is largely aimed at institutional features, organizational features, operational features, monetary policy implementation, exchange rate policy, and foreign exchange operations, as well as capacity building, while aligning both fiscal and monetary policy towards achieving economic targets in a coherent manner. Now, when setting our monetary policy, we cannot disregard the external environment. For the first time, as I said, since the GFC, no, I haven't said this before. For the first time since the GFC, there is currently a divergence of monetary policy among the major economies. This is likely to result in greater volatility in capital and currency markets. We are aware that interest rates hikes in advanced economies such as the US and UK, as well as in emerging economies, could well have some spillover impact on the Sri Lankan economy through capital reallocation. Meanwhile, economic and political developments in major export destinations, as well as trends in key commodity prices, will also have a significant impact on the domestic economy. Let me now turn to the financial sector policies. Falling in line with international standards and best practices, the central bank has introduced several policy reforms in 2017 to strengthen the regulatory and supervisory framework relating to financial institutions under the purview of the central bank. It is also noteworthy to mention that we have re-established the Financial System Stability Consultative Committee, and welcome to members today, in 2017, comprising reputed professionals as well as the representatives from the institutions and regulatory bodies in the financial sector. Inputs of the FSSC are helping in devising appropriate decisions for maintaining financial system stability. Going forward, there is an overarching need to amend the Banking Act. The central bank is proactively working with all relevant stakeholders of the banking sector and looks forward to finalizing a new Banking Act in the near term. There is a lot of material here because I know there are lots of you from the financial services community in this room. This section has a lot of material. In the interest of time, I'm skimming through some of it. I would encourage you to have a good read of this section. Strengthening the regulatory and supervisory framework for the banking sector remains at the center of our financial sector policy. As such, we are continuing to upgrade and enhance the bank examination methodology to ensure that the focus of examinations is not entirely rule-based and that it concentrates, but it's also one which gives due consideration to the efficiency, effectiveness, and sustainability of individual banks and the entire banking sector. Accordingly, Initiatives are underway to assign ratings to banks based on a combination of quantitative and qualitative indicators that will assess their efficiency and sustainability. During the course of this year, we expect to finalize the bank examination methodology based on the Bank Sustainability Risk Index, BSRI, to facilitate the transition from an annual on-site examination approach to a risk-based supervision approach. Further, we intend to incorporate BSRI to examination reports of all licensed banks and assign a supervisory rating grade for banks with effect from 2019 on a staggered basis. Banks have also been engaged in the implementation of Basel III capital standards, and implementation is to be completed by 1 January 2019. While they have been working on the improvement of their capital adequacy ratios, a capital conservation buffer and a surcharge on domestic systemically important banks have been imposed to ensure that banks actively build capital buffers. This will help to safeguard the banking sector during periods of excessive credit growth and/or adverse economic conditions. It will also minimize the systemic risk arising from the interconnectedness among banks. Under Basel III, banks will also be required to comply with guidelines regarding a net stable funding ratio with due consideration to the composition of their assets and off-balance sheet exposures. A consultation paper has been issued to banks in this regard, and the relevant standard is to be implemented during this year. The leverage ratio is also to be introduced as a simple, transparent, and non-risk-based tool that will supplement other risk-based capital requirements. The implementation of guidelines related to this ratio is expected to curb the buildup of excessive leverage in the banking sector. While we operate a deposit insurance and liquidity support scheme, an effective crisis management and resolution framework is a precondition for effective supervision. We are working closely with all relevant stakeholders to guide banks with the maintenance of appropriate recovery plans. Preliminary guidelines regarding the adoption of FRS 9 are also to be issued during the year to ensure the appropriate classification measurement of financial assets. Directions have already been issued to the banks on financial derivative transactions to streamline the risk management processes. Further, new directions have been issued on foreign currency borrowing limits based on total assets of the bank, replacing the previous direction involving assets of DBUs only. We also understand that it's essential to review the existing criteria and the mechanism for the selection of the panel of qualified auditors. So the existing criteria and selection process is being rigorously reviewed and in line with what is expected under Basel III. With a view to facilitating risk management of emerging technologies and to encourage further digitalization of banking operations, several policies will be introduced to define regulatory expectation on the use of cloud computing and define minimum regulations on the use of relevant fintech solutions. Further, a comprehensive technology risk assessment program would be concluded to assess and improve the technology risk resilience of banks. In this area, as far as the central bank is concerned, clearly progress is inexorable. We're not going to be able to hold back fintech, but the challenge for the regulator is to make sure that the evolution of technology takes place in a way that does not destabilize the system. We have a very strongly bricks and mortar branch-based system. We've got hundreds of ATMs, etc. All these things are going to get disrupted over time, but we need to make sure that the adjustment takes place in a very stable way. That's the challenge the regulator has. So we have to kind of allow technological progress, but also make sure that the adjustment does not destabilize the system. Over the last 5 years, while the banking sector has grown approximately by 15%, the non-bank financial institution sector has grown approximately by 20%. But that is changing. That is changing as we move to a less domestic demand-oriented growth strategy. The business model, the basic business model of the non-bank financial institutions are likely to feel some pressure. I think they are beginning to feel that already, so they need to now reposition themselves. They also need to have a critical mass. We have 50 institutions. That's just too many for the volume of business that we have. And let me say what we are trying to do about that. Although the sector accounts for a comparatively small share of around 8% of the total assets of the financial system, the rapid growth and broad outreach of the sector necessitates proactive supervision and regulatory guidance. While several regulations have been introduced to strengthen these institutions, some LFCs have shown signs of stress, while the rapid expansion of certain others have been curtailed due to their lack of compliance with regulatory requirements. This reiterates the need for continued strengthening of the existing regulatory framework of NBFIs to ensure the soundness of the sector and contain its spillover effects on the whole system. It should be mentioned that in addition to the board of directors, the senior management of these institutions are also equally responsible for the operations of the institutions. The central bank will not hesitate to implement the legal provisions against errant senior management if warranted in the interest of depositors. In mid-2017, we set up an enforcement division within the Legal and Compliance Department of the Central Bank to carry out duties relating to enforcement and resolution issues pertaining to financial institutions, to combating the pervasiveness of prohibited schemes and other unauthorized financial undertakings, while also curbing violations related to exchange management. This division has been now converted into a full-fledged department as of the 1st of January. We are basically, essentially, we are going to be much more aggressive and proactive in the way we regulate. In the past, the philosophy has been that we should not allow any institution to fail, and we tried to put institutions on life support, and we tended to prolong the process as much as we could. We're now going to be much more proactive. We're not going to feel shy about liquidating institutions. We are introducing a methodology which will give us a traffic light system. There will be certain ratios which will trigger off the amber lights, and once those are triggered, we will then begin to regulate very aggressively, and if necessary, to move towards liquidation at a point where these institutions still have assets. We have some distressed finance companies at the moment which are insolvent. But that was part of our philosophy at that time, was to try to keep institutions alive in the interests of the depositors. But what we've learned is that actually that doesn't serve the interests of the depositors. Once certain ratios reach a certain threshold, I think it's best to move quickly. It's in the interest of depositors to move quickly. And this is something that is being done in other countries. There is a regulatory kind of grid that's being developed. We're getting technical assistance from the US Treasury to help us to develop this grid. And so, as I said, we will now regulate much more proactively. We have also undertaken measures to enhance our surveillance mechanism. Improvements to the early warning systems are also being effected. During the last year, the system has helped provide proactive and timely guidance. In addition, the existing internal mechanism has also undergone a review process. Now, as I said, there are many institutions, too many institutions in this subsector. And what we are trying to do is to encourage, and this applies to the banking sector too, what we are trying to do is to encourage consolidation organically by increasing the capital requirements. I think as all of you know, the minimum core capital requirement for licensed finance companies and specialized leasing companies has been revised upward from rupees 400 million to rupees 1 billion by as of yesterday, followed by 1.5 billion in 2019 and rupees 2 billion in 2020. Now, there are a few companies which are having difficulty in meeting the target, and we are in discussion with them, but we are going to be very firm because, as I said, consolidation is in everybody's interest, and we need more critical mass in the institutions that survive in this sector. And if we keep giving waivers in terms of the capital requirement, clearly we're not going to get anywhere. So while we will look at action plans that are submitted to us to achieving the capital requirement within a short period of time, we really will we will not really grant waivers. This is something we're going to implement because this is the way we want to get the consolidation that is necessary, absolutely necessary for this subsector. The Finance Business Act is also being currently revamped to strengthen the regulatory framework with due consideration to the evolving characteristics of the sector. I know I'm behind schedule, so I'm skipping a bit. There's been widespread concern regarding non-bank financial institutions engaged in unethical lending practices, especially in the north and north-central provinces. Actually, it's widespread around the country. An increase in indebtedness among the public. We have been actively engaged with such institutions and other public stakeholders, including government agencies, to curtail such activity and to emphasize that these issues will be dealt with in a firm manner, while enhancing awareness among the public. We are also engaged in active macroprudential surveillance to constantly monitor developments in the broader economy and assess their impact on the overall financial stability of the country. These surveillance efforts have highlighted issues such as excessive lending for non-productive sectors, continued deceleration in the growth of total assets of non-bank financial institutions, reduced capital buffers, and the presence of weak finance companies. Accordingly, over the next few years, we will continue to strengthen the institutional framework for macroprudential surveillance through analyzing liquidity gaps and multi-currency foreign exchange risks, monitoring leverage of financial institutions, and enhancing credit risk assessments. As part of our macroprudential surveillance, a systemic risk survey is being conducted on a biennial basis to identify systemic risk to the domestic financial system. I think the survey is about to come out. Those of you who are from the financial services sector, please help us by filling in this survey. It takes you about half an hour. It's important that we get this information so that we can be proactive in the way we assess risk in the financial services sector. A more sophisticated framework is to be developed to facilitate the identification and analysis of financial and business cycles. Multivariate stress tests are also to be developed for LFCs. In addition, a countrywide assessment of household indebtedness is being carried out. Turning to payments and settlements. Over the year, the central bank has been actively involved in the adoption and implementation of measures that will not only strengthen the payment and settlement infrastructure, but also facilitate the transition to a less cash-dependent society. During 2018, we will monitor the implementation of the National Card Scheme to facilitate introduction of low-cost payment card products, such as those pertaining to public transport and social benefit schemes. With the increased permeation of fintech products, a regulatory framework is to be established detailing compliance requirements for such products and their usage. Further, in the area of cybersecurity, steps have already been taken not only to strengthen the security of the central bank, but also to ensure that the core system of banks and other financial institutions are also rigorously safeguarded. In this regard, the central bank is promoting the adoption of the Payment Application Data Security Standard, PADSS, for payment applications that may come into operation in the future. We will mandate real-time SMS email alerts for transactions made through debit credit cards, internet banking, and mobile phone-based banking. Two-factor authentication will be adopted for point-of-sales transactions, internet banking, as well as online mobile third-party fund transfers. Further, a number of policies will be adopted to facilitate modernization of the payment and settlement system infrastructure. Now, there is a whole range of things that the central bank is going to be doing. And again, those of you who are interested, I urge you to look at, we've set up in bullet form a number of measures that will be taken to improve the payment and settlements infrastructure, and also to accommodate new technology. With a view to strengthening the financial intelligence environment, we will continue to coordinate with stakeholders to develop anti-money laundering and countering financing of terrorism. Here, we're looking at the various key acts, trying to reform them. We are going to implement the Financial FATF, Financial Action Task Force, which is the OECD body that sets standards in this area. As I said, we need to up our game, and we are determined to do that. We need the assistance of a number of government agencies to do so, and we will be working closely with them to achieve that objective. During the year, the central bank continued to strengthen the regulatory framework of the microfinance sector as well by issuing directions to licensed microfinance companies. and principles, standards, and guidelines to the Registrar of Voluntary Social Service Organizations for the regulation and supervision of microfinance NGOs. Now, this is again an area where we are trying to strengthen the regulatory framework, and we plan to issue further directions in the period ahead to strengthen the regulatory and supervisory mechanism for microfinance. Now, while we make every effort to put other financial institutions in order, clearly we have to put our own house in order. In line with this, implementing an enterprise-wide risk management framework and strengthening compliance in the bank has been identified as one of our strategic priorities. As I said, we have 6 strategic priorities which are bank-wide efforts, and this is one of them. Implementation of an ERM framework helps to move away from a silo-based approach to a whole-of-business approach to risk management. This will support more informed and risk-aware decision-making at the top, while strengthening risk mitigation culture, enhancing internal governance, optimizing risk management, and promoting efficient use of resources while building confidence of stakeholders and the community at large. The new risk governance and risk management structures, along with the 3 lines of defense model, will be established, putting in place an overall risk management policy statement for the whole of the central bank. Implementation of this throughout the central bank would also help in inculcating a robust risk and compliance culture within the bank. Further, a compliance framework will be developed in line with established global benchmarks. Now, to our agency and ancillary functions. Currency management. As you know, the central bank has always taken measures to ensure the availability of currency for the use of the general public, and we are making several efforts to improve currency operations and processes. Again, please read this section, those of you who are interested. We have introduced a single note inspection system to improve the quality of newly printed currency notes with a view to ensuring 0 defects in currency notes. With a view to strengthening, we are also strengthening the implementation of the clean note policy. You would have seen some press notices instructing licensed commercial banks not to accept willfully mutilated and altered or defaced currency notes. The original deadline was the 31st of December, but that was during the holiday period, which seemed to cause some disruption. And this was a manner on which we got direct signals from the President, His Excellency the President, the Honorable Prime Minister, the Honorable Finance Minister, and Senior Minister Nimal Siripala de Silva. So it's not something we could ignore, so we've extended the deadline to the 31st of March from December last year. We are also planning to issue new coins, a new coin series, by changing the metal of the coin, which would reduce the cost of minting while also increasing durability. In the medium term, we intend to establish a state-of-the-art cash center to improve currency operations. The current facility is running out of space and has rather trying working conditions, so we want to see whether we can establish a state-of-the-art cash center. Public debt management. We consider prudent debt management as one of our highest priorities given the challenge of managing very large debt stock. In fact, to break away from a potentially vicious cycle of debt, the central bank has made prudent debt management a bank-wide strategic priority. This is again another one of the bank-wide strategic priorities. As you all know, the central bank is responsible for raising, managing, and servicing of government debt and carries out its functions with the objective of ensuring that the government's financing requirements are met at the lowest possible cost. Several measures were implemented in 2017 to enhance the transparency of debt management operations. In July, a new hybrid primary issuance system for treasury bonds was introduced to enhance the efficiency and transparency of domestic borrowings of the government. And as I said earlier, we've already seen good results from this. We have also published an issuance calendar for government securities on the central bank website on a rolling basis to improve the transparency and predictability of the primary auction process and government securities market. And we will not in future accept anything more than the offered amount. Of course, we could accept less if the price is not right, but certainly we won't accept more than what is what is advertised. Looking ahead in 2018, we will continue to work towards enhancing the security, efficiency, and transparency of public debt management further. And subject to the enactment of the Liability Management Act, liability management measures will be executed in order to improve the underlying risk profile of the public debt stock. This would enable us to minimize the refinancing risk by altering the maturity profile of the outstanding debt stock. Under this initiative, activities such as buyback, switching, and pre-funding arrangements will also be explored, not only to increase the tenor but also to reduce the cost. Similar to bonds, we will also take measures to introduce a new primary issuance system for treasury bills to further improve transparency and efficiency of government borrowings from the domestic market. In order to deepen and broaden the secondary market for government securities, and also to increase transparency even more, we propose to establish an electronic trading platform and a central counterparty arrangement along with the required legal reforms. Through this arrangement, we will establish a mechanism to disseminate information on debt instruments in the secondary market with a view to enhancing transparency and eliminating the risk of imperfect information among agents in the market. We hope to have this in place by the end of the year. And certainly that would be a major development in terms of strengthening the operations of the debt market. Now, on behalf of the central bank, on behalf of the government, the central bank will also continue to tap commercial sources, to tap the international capital markets to mobilize money for the government. And we are hoping, in fact, to go to the market early this year. We think it's prudent to go to the market early for a number of reasons. For one, in the first couple of months of this year, there is a wall of maturities, sovereign debt maturities, something like, is it 40 billion, I think, US dollars of maturities are coming on stream. So there's a lot of money that will be available. So there's a big supply side kind of rationale for going to the market. Secondly, of course, the US interest rate cycle and possible tightening by the ECB as well, which could push up costs as the year goes ahead. And then the third reason is if we're able to go to the market and bring in a large amount of money, it does reduce pressure on the interest and exchange rates as well. That's a lesson that I've learned in the brief period I've been here. We've had two such issuances, but they were in July and May, I think, through no fault of our own the second time. But I think you need to do it early in the year if the market conditions are right, because it takes a lot of pressure off the system. Management of the EPF. Now, because I'm way over, again, those of you who are interested, there's a lot of interesting stuff. Essentially what we're trying to do is using technology to provide more efficient and more user-friendly services for both the fund members as well as employers who have to contribute into the EPF. Number of changes are being made, which is actually streamlining the system and making it far, far more user-friendly. And we are also strengthening the investment process. The investment committee, the working of the investment committee. We are getting technical assistance to build up the capacity of our officials working in this area. There's assistance from both the ADB and the World Bank to improve internal processes in line with international best practices. And there's a lot of training that we're getting as part of an ADB program as well. Foreign exchange management, as you know, there's a new foreign exchange management framework, which has been established by a new act of parliament. The new foreign exchange policies are basically focused on facilitating integration with the current overall policy stance of the country, which seeks to promote competitive advantages of Sri Lanka in the global business environment. So essentially, I guess the philosophy behind this new act is that our growth and employment generation process can be benefited by opening up more to the international trading system and international capital markets. So that is what this act tries to do. That doesn't mean that we've taken away all capital controls. We certainly haven't. We had already liberalized all current account transactions way back in, I think, 1989 or 1990. On the capital account, there are still restrictions, but what we are trying to do is to facilitate the movement of money in and out so that we can, as I say, integrate more effectively to the international trading and trading system and capital markets. But the corollary, or in parallel, we need to improve our anti-money laundering and CFT processes. So that's essentially, and we are going to strengthen that, and as I said earlier, and to improve surveillance on that side and to reduce non-compliance, because the two things have to go in parallel. Regional development. There are a number of concessional programs implemented through the participating financial institutions by our Regional Development Department. There are a whole series of concessional programs to target the agriculture, livestock, MSMEs, high priority to financial inclusion and balanced regional development. The government used the central bank to implement 2 new credit programs, the Sure Shakti scheme to promote young entrepreneurs, and the Atwala scheme for flood-affected businesses. My colleagues in that department were able to rise to the occasion and to deliver these programs effectively. Okay, concluding remarks. At the beginning of the year, our country faced several challenges and uncertainties. Nevertheless, supported by the proactive stabilization policy measures adopted by the central bank and the government, we have moved steadily towards achieving overall stability of the economy. But we do not want to be complacent with the achievements so far, and we acknowledge that several challenges continue to weigh down on the overall macroeconomic performance of the country. Therefore, we need to work hard in order to restore the stability of the economy on a permanent basis in order to create an enabling environment to raise the living standard of our people, and we believe that the policies outlined in the roadmap will help in this endeavor. Now, as I said, I keep using these other war-oriented analogies. I keep talking about battles and wars, but what I should say is maybe we are still really in the foothills of the mountain range in terms of what we have achieved. There's a lot more to go to the top of the mountain. So we need to persist. We have made good progress, but we need to keep persisting. In the meantime, we require broad-based reforms and commitment to enhance the country's growth potential. As the agent for macroeconomic stability, the bank will always work hand in hand with the government to enhance economic growth through maintaining low and stable inflation and ensuring financial system stability. We believe our future policy directions and actions set out in the roadmap will serve as a guidance to you to plan ahead and to formulate and align your actions in line with the broad policies of the economy. We would also like to note that we will be prepared to introduce new policies and measures not in the roadmap, if warranted by the dynamic macroeconomic conditions and market developments. We live in an age of rapid change, so we need to be able to respond, and if necessary, we will go outside what's in the roadmap to respond accordingly. This flexibility is necessary in a world of elevated risks and uncertainties as well as rapid change. Similarly, we strongly believe that the government would continue its fiscal consolidation measures, which will support us to pursue our policies towards macroeconomic stability. In particular, this will be a necessary condition for us to successfully adopt the FIT as a monetary policy framework. Before concluding my speech, I would like to convey my sincere gratitude to a number of individuals who constantly contribute and support our efforts to carry out our functions of the central bank effectively. First and foremost, I am grateful to His Excellency the President, Maithripala Sirisena, the Honorable Prime Minister, Mr. Ranil Wickremesinghe, for their guidance and leadership. I would also like to thank the Honorable Minister of Finance and Mass Media, Mr. Mangala Samarwila, for his support, especially in making every effort to ensure close coordination between the Ministry of Finance and the central bank. I highly appreciate the ample support and prudent inputs from the members of the Monetary Board of the Central Bank. They have been working long hours in helping us to tackle some of the major problems that we have, way beyond the call of duty. So I'm deeply indebted to them. My sincere gratitude goes to the Secretary of the Treasury, Dr. R.H.S. Samaratunga, Mrs. Manohari Ramanathan, Mr. Krishanta Pera, and Mr. Nihal Fonseca, who are the members of the Monetary Board. I'm also grateful to the Senior Deputy Governor, Dr. Nandalal Veerasinghe, the Deputy Governors, Mr. K.D. Ranasinghe, and Mr. C.J.P. Sirivardhana, for their enormous support and for their highly professional advice and recommendations. The central bank is truly blessed in terms of the people it has, and certainly the senior management of the central bank has a great deal of technical expertise, and they conduct themselves with the utmost professionalism. I must say this in the context of some of the stuff going around. We have highly professional, highly committed senior staff and other staff members in the central bank. I would also like to acknowledge the unstated service rendered by the former deputy governors, Mr. P. Samarthi and Mr. Lanka, who retired from the bank service in 2017. I would also like to express my gratitude to the assistant governors, senior heads of department, and in this instance, particularly the Director of Economic Research and her staff, for their effort in compiling this policy document. As I said, I would encourage you to read this. What I have told you is only part of it. There's some excellent material which have lots of insights. I must also express a special word of gratitude to my colleagues in the Governor's Secretariat, who have had to put up with me on a day-to-day basis. In fact, I thank all staff of the central bank who are dedicated to fulfilling the objectives of the central bank and to maintain their professionalism, technical excellence, and integrity for the betterment of the country. However, as you're aware, it has been revealed that a very tiny minority of the central bank staff have not lived up to the very lofty standards that are expected in this iconic institution. In such institutions, firm action has already been taken to stamp out such wrongdoing, and we will continue to do so in the future. Thank you, and I wish you all a happy and prosperous new year. I'm sorry I've detained you so long. Thank you very much.